My name is Jake, welcome to the channel. In today's video, we're gonna talk about math. The math that you need to know in order to retire early off of your dividend growth portfolio. When my wife and I were first starting out and trying to reach our goal of financial independence, we had the goal. We knew that we didn't want to work our entire lives. We knew that we wanted to be flexible, maybe live 1 year in Texas, 1 year abroad in Europe. We had the goal, but we didn't really have the vehicle. We didn't really know how we were going to get there. And it was kind of in the back of our minds, okay, we're going to retire early one day and we'll hope for the best. When it comes to your investments, it's really just a matter of math. It's numbers, it's percentages, and you can calculate them. Now, obviously the market goes up and down. We can't predict where the market is going to go. We can look at historical charts, but we don't know for sure. This video is going to help you if you're a new investor or you're just starting out learning about dividend investing. I promise you this video is going to help you so much when it comes to calculating your expected returns and help you understand how long it's going to take you to retire off of this strategy. When I was first setting up my portfolio, it was a little bit intimidating. I didn't really know, okay, what were the best investments? What type of investment do I need for my particular situation? If you've been following my channel, in my Review My Pie series, I have a lot of different individuals across the globe, sharing their portfolio, and I talk a lot about time horizon. Your time horizon really dictates what type of investments you should be invested in based off of your age, your goals, etc. Now, math can be a little bit intimidating. When I was first starting learning about dividend investing, I was just kind of going with the flow and, it sounded cool, passive income, don't have to work, once you reach a certain level, yada, yada, yada. But the math can be a little bit intimidating at first, but it doesn't have to be. So I want to talk about how you can use math to your advantage to help you retire earlier. Now, the math that we're talking about here in this video is very simple. We're talking about compound interest, and it's not a very complex topic. But despite that, I'm sure there's going to be a few of you watching the video that are going to feel a little bit like this.
What? Okay, if you're going 80 miles per hour, how long will it take you to go 80 miles?
Yeah.
I don't understand. So do I divide something? 80 miles per hour. How long does it take you to go 80 miles?
Yes.
I don't know.
What?
Oh man, it hurts my brain just thinking about that. All right, so what I want to talk about here, there's a few things that you have to understand before we dive in and we look at, particularly when it comes to dividend investing. I think there's a concept that is important that everyone understands. If you're starting out, it's important that you understand the power of compounding, right? And there's a way that you can understand this is by understanding the rule of 72. What the rule of 72 is. Essentially what the rule of 72 is how long it takes an investment to compound or to grow at 100%. So for example, if you're invested into a bond or an investment that grows at 2%, it's going to take you 35 years to double your money. Okay. Now on the other side, if you're invested in a company that is growing, maybe let's say, I don't know, 5% every single year, maybe this is a corporate bond or a little bit more of a mixture of bonds and stocks, your portfolio is going to grow or double every 14 years. Now, 14 years is not bad. It's pretty good, but it's not nearly as aggressive as where you should be if you're first starting out. So if you're 20 years old and you have 40 years of compounding, you can take on a lot more risk and you can really be aggressive in how you're structuring your portfolio. So for example, if you're investing into the S&P 500, the S&P 500 is right around a 7% rate of return. And so if you're just invested in the S&P 500, you're doubling your money every 10 years. Okay. Now, if you're invested into something that's really, really growth oriented, it's just blowing it out of the park every single year at 25%, you're going to double your money every 3 years. So it's important that you understand. So if you're 20 years old, understanding this chart here, this table, that the higher up here, so the 2, 3, and 5%, these are your more conservative investments. The further down you get on the chart here, that's the more aggressive you're going to get into the the type of assets or investments that you're invested in. Now, obviously, this fluctuates every single year, but it's important to understand the rule of 72. How long it will take an investment by the rate of return to double. Now, the traditional way of calculating your investments and using a compound interest calculator, this is more so for your 4% rule. This is not really applicable for dividend investors. And I'm going to explain why in a second. It's a great way to get your total portfolio value, but it's not incorporating the dividend growth. It's just looking at the total return. Okay, and I promise that'll make sense. If you're a new investor and you're not sure what I mean by that, I promise later in the video here, I will explain what that means. So a simple compound interest calculator is just looking at the total return, the dividends plus the capital appreciation. And so if you talk to anybody that's looking to retire just off of their portfolio and not focused on dividends, this is the calculator that they're looking at. The majority of people are familiar with this calculator. And this is different than what a dividend investor is going to use. Okay, so if you're looking at this investment type, $10,000, adding $1,000 a month for 10 years at an 8% rate of return, you're going to have just under $200,000. Now, the simple way of doing that, you could say, okay, well, Jake, that's great. Let me just take $200,000, times that by 3%. Let's just do it right here for a second. You got $195,000. And let's say, okay, in 10 years, I'm going to take all of this investment, say it was in the S&P 500, I'm going to sell everything, and then I'm just going to buy, let's say, Coca-Cola that's yielding just over 3%. Okay, if you were to do that, then you're going to get over $6,000 in passive income from the dividend. Okay, but we're going to go a little bit further than that. We're going to go beyond that because the dividend is still growing, and how do you calculate that going forward? So in order to do that, what we're going to do is we're going to look at the reinvestment calculator based off of a few assumptions, and we're going to look at a few different companies, a few different examples. Now, this comes down to your time horizon, and I promise you this is going to get really exciting, especially, if you're following along in this video, you're going to see, I'm hoping that by watching this video, you're going to have that light bulb effect. That you're going to have that aha moment, like, okay, I get it, right? That's the goal. That's what I'm trying to achieve by sharing this and the thought process of calculating the numbers behind your portfolio. So what we're going to do is we're going to take 3 companies with 3 different assumptions, and we're going to plug them into the dividend reinvestment calculator that I shared on a previous video. And we're going to see, okay, how long it would take to reach a certain threshold of dividend income. And once again, we as dividend investors, we're mostly concerned about the dividend income. The capital appreciation, it feeds the ego, right? It's cool, but we're focused on the dividends. All right, so in order to do this, what we're going to look at a few assumptions. Now, these assumptions are not going to include inflation. Now, inflation is hovered right around 2%. The Fed have said that they have a target inflation rate of around 2%. That is their goal. All right, this is not going to include taxes. Now, the capital gains tax here on qualified dividends is around 15% for most Americans. Now, this is something that if you're outside of the United States, you'll want to understand the capital gains tax rate for dividends in your country. The growth rate is going to assume a historical rate over the last 5 years. Now, as I mentioned earlier in the beginning of the video, you don't have a crystal ball. We don't know what the stock market is going to do in the future. So we're using historical returns, and we know that historical returns are no guarantee of future returns, but we can't really work off of anything else. So that's why we're going to do that. And this is looking at the historical dates as of January 1st, 2012. Now, you're probably asking yourself, okay, well, Jake, how did you get these numbers and how could I do it myself? Let's say, for example, you don't invest into Coca-Cola, but you invest into a different company. How could you do this yourself while following along if you're following along at home? All the numbers that I got here, so the annual return, the dividend growth, and the 4-year average dividend yield, I got from Seeking Alpha and a different site that I'll show you here in a second. So the dividend growth you get here from Seeking Alpha under dividends and dividend growth, and you take the 5-year CAGR. CAGR stands for compounded annual growth rate, and this is just the dividend. This is not the total return. Very, very important, just the dividend. And if you want to get the yield, what I don't like taking the current yield. I like taking the average yield over the last 4 years because this, I feel like it's a little bit more representative of what future returns will potentially look like versus just taking what is currently yielding, right? And so that's why I like taking the 4-year average yield. When it comes to the total return, I go over here and I use a different website for this, which tracks the total return using the drip function. So if you were to invest in a Coca-Cola as of beginning of January 2012, what would your total return be? Your total return would be just under 7%. And total return is capital appreciation plus the dividend reinvested. Okay, so if you wanted to do this for a different company, you could type in the ticker here. If you wanted to do it for an ETF, you could do it for an ETF. But the important thing for this website, what we're looking for is we're looking at the date and we're looking at the annual rate of return, which is 7%. And that's where we're getting these numbers right here. When it comes to the annual return, we got Coca-Cola is at a 7%, right? The dividend is a 3.3. So we're going to take 7% minus 3.3, and that's going to give us an annual capital appreciation of 3.7%. Not a crazy amount, actually pretty low. And when you look at the dividend growth rate over the last 5 years, we're going to take the 4.5. So these are the numbers that I'm using, and it's the exact same process for waste management and air products and chemicals that we're going to look at here. So we're going to look at these 3 different companies. These 3 different companies, if you look here, they have different growth rates, different current yields, and different capital appreciation rates. All right, so now what we're going to do is we're going to take these numbers here and we're going to plug them into our dividend reinvestment calculator, and we're going to see what the future growth of the portfolio would be, as well as the dividend cash flow. Now, this is so important because if you have a specific goal, let's say you're 20 years old and you want to reach a certain threshold in yearly cash flow, you're going to need to know, okay, well, what type of investment would help me reach that goal? Now, if you're 40 years old or 50 years old, this is going to look probably pretty different. Maybe you have a 5-year time horizon or longer, right? So the big thing here is the age doesn't really matter. What really matters is the time horizon. And we're going to take a look at all 3 of these, Coca-Cola, waste management, and air products and chemicals, and we're going to see what is the growth of this portfolio, and we're going to use the same assumptions in terms of the amount that we're investing. Okay, so what we're going to do is we're going to take a look at the dividend reinvestment calculator here. I put this spreadsheet together. I'll share a link in the description below. You can use it for free. All you have to do is go in here to make a copy. To edit, you go in here to File, you go make a copy, and you save it to your own Google Sheet, and then you'll be able to make edits to the spreadsheet here. All right, and so before we dive into the different metrics, I think it's important to understand what this is looking at. So this sheet here, the only things that you have to update are in yellow. The amount that your portfolio is currently valued, the annual deposit, so how much you're investing into the portfolio on an annual basis, and then here the capital appreciation, the dividend growth, and the current yield. These are the numbers that we're pulling from the investments, right? Let me go back over here. This is why it's so important. These things right here, the annual rate of return, the dividend growth, and the 4-year average dividend yield, we're going to plug those into these fields up here in the top. Now, these fields A and B, that's going to be obviously depending on your particular situation. How much you have in your portfolio today and how much you're adding on an annual basis. Now, down here on the bottom, I have a few notes. For example, when it comes to the how I got the total return, right? That website that I was using right here, I leave a link in the file here. You can click on the link and you can go, if you're using an individual company or an ETF, you can get the total return. All right, and there's a few notes as well on how to get the dividend growth from seekingalpha.com. Okay, and as always, everybody, past returns are no guarantee of future returns. So it's important to understand that when you're calculating this. And then lastly, down here on the very bottom, the different tabs, this is with the dividends reinvested from day one. This is living off the dividend income in the future, right? So let's say, for example, you're going to invest up to 10 years. And then after 10 years, you're going to no longer reinvest the dividends, but the portfolio is still going to grow. right? Like that's the important thing. So you reach your goal in 10 years and then the portfolio is still growing every single year. If you say, for example, you want to change it to 15 years, all you have to do is update this column right here based off of the shares that you owned, and then it'll pretty much essentially stop reinvesting the dividend. So you'll have the same shares owned. And then this tab right here is taking the assumption that if you were to retire today and you have your growth metrics in there, what would your portfolio look like? And you can look at the chart here on the right. All right, so let's take a look at the first one. So if you're invested into Coca-Cola, right? Remember the first one here is Coca-Cola. These are the growth metrics of Coca-Cola. If you have $30,000 invested and you're investing an additional $30,000 every single year, this is what your portfolio is going to look like every single year. So after the first 5 years, you're going to have $7,000 in annual cash flow. Now, I don't know about you, but I can't live off of $7,000. All right, so then we need to do a couple of things. We either need to change the investment, we need to have a company that has a higher current yield, or we need to invest more money. So it's usually one of those two things, right? Either you need to extend your time horizon, or you need to make more money. You need to cut your expenses. You need to get out of consumer debt, right? All of those things. Let's say, for example, okay, we're going to take it to 10 years. In 10 years, you're getting over $16,000 in annual cash flow. That's a lot of money. That's a good chunk of change. I couldn't live off of it, but yeah, I could definitely supplement my expenses with $16,000. Now let's say with 15 years. With 15 years, you're getting $31,000. $31,000 is a good amount. And then if we look at 20 years, you're getting over $50,000 in annual cash flow in 20 years, just with Coca-Cola. Now, Coca-Cola is just an example. I'm sharing this just as an example when it comes to the numbers. I'm not saying here, hey, go and invest all of your money into Coca-Cola. That's not what I'm doing here. I'm sharing just the growth metrics around an investment like Coca-Cola. All right, so now let's take a look at our second example with waste management. With waste management, you're getting a much larger annual return in terms of the capital appreciation, 15.5%. Waste Management is a growth company. This last year has been really difficult on Waste Management, but it is just an incredible company. It's just destroyed the S&P 500. With the exception of this year, or the last year in 2020, it's been pretty difficult on them, but it is absolutely a growth company. When it comes to the dividend growth, it's not growing its dividend quite as quickly, right? It's more of a growth company in terms of capital appreciation, but it does have a decent dividend growth rate at 7%, and it's averaged over the last 4 years right around 2%. Now, if we plug in the numbers from Waste Management, we're going to get a completely different story. Okay, so let's go over here and let's take a look at the chart. So with Waste Management, if we were to invest the same amount of money, the $30,000, you're going to have just under $4,000 in cash flow in the 5th year. In the 10th year, you're going to have just under $8,000. In the 15th year, you're going to have $13,000. And in the 20th year, you're going to have just under $20,000. So significantly less than Coca-Cola. Now, the important thing to point out with Waste Management, and this is the reason why I don't have Waste Management at the highest allocation in my portfolio, because I want to live off of the dividend cash flow, is because Waste Management is not growing the dividend as quickly, you're not getting as much dividend income in your 25th year, your 30th year. It's growing much slower than other investments. But if you look at the total investment, right, I think this is the important thing to look at. In 30 years, you're going to have over $16 million in your portfolio. So this is the type of investment as Waste Management. It's not a pure dividend play, and that's why I don't have Waste Management at the highest allocation in my portfolio. So it's going to take years, decades to outpace Coca-Cola with the same parameters and the same investments, right? With a $30,000 a year. Okay? So that's important to understand. So if your time horizon is 30 years or plus, then yeah, Waste Management is a great option. But if your time horizon is shorter than 30 years, yeah, Coca-Cola is actually a better dividend choice in terms of that when we're just looking at the cash flow. Okay, when it comes to the total return with the capital appreciation, Waste Management is obviously a clear winner. But when it comes to dividend investing, Coca-Cola is the better choice. All right, let's take a look at the last one here, Air Products and Chemicals, APD. The annual return is 17%, so just slightly under Waste Management. The dividend growth rate is absolutely insane. With a 12% dividend growth rate, this is absolutely blowing the pants off of Waste Management and Coca-Cola. The 4-year average dividend yield is around 2.3%. So if we plug this into the numbers here really quick, when it comes to the portfolio value, you're going to get a similar portfolio value as with Waste Management here, just over 16 million. But what's really interesting is the dividend cash flow. The dividend cash flow, because the dividend growth rate is so insane, because it's 12%, you're going to see this chart look entirely different than the other two. So if you were to invest the same amount of money into Air Products and Chemicals, after 5 years, you'd have over $5,000. Now, this is where it gets interesting. After 10 years, you'd have over $14,000. And then after 20 years, you'd have $61,000. After 30 years, you'd have over $220,000 in cash flow. That's passive income. This is absolutely incredible. In 30 years, you're getting over $220,000 in cash flow. Now, this is obviously assuming that you're reinvesting the dividends for the last 30 years. Now, I want to get to the most important point of this entire video. And if you've been watching the video this far, I'm really excited because this is the highlight of the video. When looking at these 3 different investments, all 3 of them are growing at different rates. The most important thing here to understand is your time horizon. When you look at this chart here with APD, after 16 years, you're getting over $35,000 in annual cash flow. This is more than what you would get with Coca-Cola. So this is the light bulb, everybody. This is the light bulb effect. If your time horizon is longer than 16 years and you're comparing investments, APD is clearly better than Coca-Cola. However, if your time horizon is shorter than 16 years, Coca-Cola is a better investment. Now, it doesn't have to be all or nothing. It doesn't have to be all Coca-Cola or all APD. But when it comes to your allocation and setting up your portfolio, you would want to overweight your portfolio in APD if you have longer than 16 years. The math does not lie. Once you understand this, you understand the different investments and how they're growing and how they're growing differently. And when you're comparing different investments, right? If you follow any different community blogs on dividend investing where people are always asking the question, hey, should I invest into this or should I invest into this? It really depends. And what it depends on is exactly what you're seeing in front of your screen. It depends on your time horizon. Your time horizon dictates how you should invest into your portfolio. That's the aha moment. That's the light bulb. If you stuck with the video this far, I'm so excited. I hope that this was helpful. I hope that you got that light bulb effect as well, and you truly understand this. And I believe that when you understand this, you will never look at your portfolio the same way. You'll look at your portfolio in terms of numbers and math. And once again, this is a moving target. The 12% is not guaranteed. It's not guaranteed that Air Products and Chemicals grows at 12% every year. It's possible that they grow at 15%. It's possible that they grow at 5%. It really depends on how the market is in, what cycle the market is in. But if you understand this, you can construct your portfolio so that it meets your goals. Living off of your dividend growth portfolio is absolutely possible. It's important that you understand that this is different than the traditional 4% rule. This is different than the simple compounding interest calculator because the portfolio is still growing. It's still growing organically. The charts that you see here are set up where you're reinvesting the dividends. But the thing is if you're invested into APD, for example, you don't have to reinvest your shares or you don't have to buy in and accumulate more shares for the portfolio to continue to grow. And that's the magic of compound interest. That is why it is so important that you understand which investments you have in your portfolio and not because somebody else told you. If you hear anyone or if you read or watch a video where they say you should invest into these top 5 dividend stocks or these 5 different dividend stocks, The first thing after understanding this, you have to ask the question, okay, well, what's the dividend growth rates? What are the growth rates of these individual companies? Before I understood this concept, when I was constructing my portfolio, I was just kind of picking and choosing at random what dividend companies I really liked. Right? Did I understand the company? Did I like the brand? Did they have a good track record, right? And all the different companies in my portfolio were kind of just thrown together, right? This is how I first started out when I was learning about dividend investing. I would follow different blogs. I would read watch different videos about the best dividend stocks in 2020, in whatever year, right? And you consume all this information, but once you understand the reinvestment calculator, once you understand the growth rate of these different companies, it's not just, hey, this is a great company, but, well, does it fit my needs? Does it fit me as a dividend investor? Yeah, Coca-Cola is a great company, but Coca-Cola is not the best dividend investment for every individual out there. It really depends on your time horizon and what, the amount of capital, right? We use the equation or the assumption that you were investing $30,000. Let's say, for example, you could only invest $10,000, or let's say you were investing $100,000, right? All of this is so unique to every individual. So what I would encourage you when you're doing this, when you're evaluating your portfolio, ask the question, what is your goal? What is your time horizon? And let the math guide you in setting up your portfolio. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. If you like today's video and you love math, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.